Hi guys. So I wanted to do a quick video on what I consider it's one of the most relevant investing concepts, and that is, as you can see on the screen, no, why quality is more important than valuation. And I mean, this probably doesn't sound new to you, even if you ever listen to Warren Buffett investor calls, he usually mentions this. And the way actually he puts it is that it's better to buy a good company at a fair price rather to buy a not so good company at a discounted price, no? And this maybe sounds obvious, but when we think about um, the way many people look for stocks to invest in and so on, the first thing that people usually do is to evaluate the company, no? And figure it out, build a DCF model, discounted cash flow model, and then basically figure it out if the future cash flows of that business, you know, give a, a higher or lower intrinsic value to the company that the price that it currently has, no? So many times we directly look at valuation and we don't think about the business itself, no? Um, and I think it's important that before jumping into doing all these models and all these things, we first need to understand if this is a business we want to be invested in for the long term, no? Is this a good business? And the next question, no, it's how we define what's a good business and what's a bad business. Um, and here probably there are also many different strategies to analyze a company. Um, and for me, to keep it simple, the most important factor is whether the company has strong defensive modes, no? Modes that will last in the long term. And I mean, and there are many other things that you need to analyze probably, there's management, capital intensity of the business, probably some macro factors even, maybe not so important. Um, but the most important metric by far it's the defensive mode, no? Is does this company have a strong defensive mode against competitors, and is this mode going to last in the long term, no? And in the long term I mean 20, 30, 40 plus years. And then probably the next question is why I consider this to be the most important factor, not that defines a quality business. And this is because companies with a strong competitive mode usually are able to maintain high returns of capital over the long term, no? So as you can see in the graph, a company with a competitive mode is able to maintain a high return on capital during very long periods of time. If the company doesn't have a competitive mode, what happens is that many other companies in the industry, in the same market and so on, will start to copy um, that that edge that you have that allows you to have a higher return on capital than the market, and therefore it will push down your returns of capital until you go back to the market average. So competition, will eat into your margins, into your revenues, market share, whatever. No, but one way or another, they are going to affect your return on capital in the long term. And this matters a lot, no? And why does this matter? Because we can look at one example, and this is maybe a bit complicated, no? But we imagine that we have two businesses, no? We have company A and company B, and the main difference between the two companies is that company B has strong defensive modes, and therefore the return on capital will assume that stays constant in the next 30 years at 15%, whilst company A doesn't have, a strong return on capital, but we're able to buy shares of the company at a 20% discount versus company B, no? So we're basically comparing um, the competitive mode of the company and therefore the importance of returns of capital versus the importance of valuation when investing, no? And in the case of company A, if we were to invest $1,000, we'll get 125 shares, and this will be the profit generated by our shares, no? The profit per share, let's say, well, for all the shares. And in company B, for the same $1,000 investment, we would only get 100 shares, and the profit generated from our shares would be $1,000. So what happens, no? When we when 30 years pass, we can see that company B, the profit generated starts compounding at 15 per year, no? So from from in the first year we generate 1,000, but in the second year we generate 1,150, and so on, and this starts accumulating. And at the end of the 30 years, we have 500,000 dollars, no? And then if we look at the case of company A, and here I also assume that after 10 years, we take the money out of company A and invest it in an equivalent company A that has still high returns of capital at first sight, but as you can see, this decrease in the 10-year period that we hold the investment. No? So to make a more equivalent comparison, I assume that, okay, after the first 10 years, we realize that company A starts giving us average market returns, take the money out and put it in another company that also has 15% initial return on capital, but also decreases by, in this case, by 5% per year, no? So 5% increments per year. So the first 10 years go by, we get 3,500, we reinvest this, we get in an equivalent company, and then we get almost $13,000. We repeat the process, and at the end of the 30-year period, we have $45,000 compared to the $57,000 of company B. And remember that we bought company A at a 20% discount versus company B, which it's a very significant discount. And we also assumed that the returns of capital, are not in the end the average return. Probably we can calculate it. Average return on capital, it's 12%. So it's over 30 years, which is quite optimistic for a company with no defensive modes. And then company B, 15%. So a small difference in return of capital. In this case, the average difference is 2.5%. Compounds quite significantly over time, and we get probably this is, let's say 10,000, 20% probably higher return on company B, even though we bought company A at a much cheaper price, no? So this is just a very quick example to illustrate that maybe it's more important to find good businesses rather than to focus on valuation, because also in this case we did 3 times the amount of work, no? Because we had to find an equivalent company, reinvest the money, and so on, no? And in the case of company B, we just invested and then we forgot about it. We didn't have to do any additional work. So the choice is clear, no? I think that we should focus on companies that have high returns on capital, and this usually means that they have strong modes. And the next question, probably, and the final one that I wanted to discuss in this exercise, it's how can we find companies with strong modes, no? And here I also prepared a very, very quick example, and there are probably many different ways to find companies with strong modes. I will only discuss 2, and one it's more of a common sense approach, and the other it's this one, no? And in this one, basically, we can imagine that we have two shoe stores, no? We have Y and Z shops, no? And both of them are selling shoes. And then if we look at the balance sheet of these two companies, we can see that both of them have the same amount listed as property plant and equipment, and also the same amount as inventory. What does this mean? No, having the same amount in inventory, uh, and as you need to remember, inventory is listed at production cost. No, so it means that the raw materials or the product that the price for the product that they are selling, the price that they paid for the product that they are selling, it's the same. And then for property, plant, and equipment, we also have the same value. And that means that, I mean, to simplify things, we could assume that they own the physical space where they are selling the shoes. So having the same price listed for that means that both stores will have similar locations or equivalent locations in terms of foot traffic in the area, similar size of the shop, and so on. No? But company Y has basically half the operating income of company Z. Why? Why is that? No, and this is sounds like a simple question, but it's not. No, and obviously if we make the ratio of tangible assets to operating income, we can see that the company Y it's 25%, on company Z it's 50%. This means that company Z having basically the same location in practice and paying for the same for the products that they are selling, they are able to generate twice the amount the income of company Y. No, and here maybe you can stop. You even can stop the video and think about how is it possible, and what could be the reason for that. And for some of you, it may be pretty obvious. And now maybe I can give you, another piece of information, another hint, let's say. What if I told you that company Z is a Nike, let's say, let's assume, or ASICS, no, or a Nike owned store, and that company Y just sells, white label shoes or not so well known brands of shoes, no? Then it's obvious, no? Because you quickly realize that the reason why company Z is able to generate a higher operating income, it's because they have Nike brand, the Nike brand behind their products, and they are able to charge more to customers, and therefore their margin on the same cost of products sold, it's higher. No, their gross margin is higher, so this allows them to generate a much higher operating income and a much higher return on tangible assets. So in this case, no, the moat, and we just guessed, we would need to look into the real business actual to discover what's the moat. It's the brand, no, which is a very common form of defensive moat that companies have. So what I'm trying to get to is that we can use the ratio of return on tangible assets to find indications of companies with moats. No? So if we were to look at all the companies in the same industry and compare the return on tangible assets, and we find that one is much higher than the others, then we could identify that a company has a moat without actually even looking at the business, no? And then we can look at the business and we need to understand why that company has a moat, no? But this is a very useful metric to find moats, basically companies with moats. And obviously it doesn't work for all industries equally good way. So for software companies, I think it doesn't work that well. And then for pharma companies, it does work, but you need to take into account some other things, and that's why I'm doing a separate series on how to assess pharma companies, no? But overall, for most industries, it's a very good metric. And then probably the next, there are many approaches, no? And actually, if you have another one that you can use at scale to find companies, please feel free to put it in the comments. But another approach that I like to use, and this is what I call common sense approach. It's trying to understand the rate of change of an industry, no? And let's put some examples. Um, let's say that we're looking at tobacco companies, no? Then we can ask ourselves, how long have people been smoking tobacco? And I don't know when people started smoking tobacco. I didn't check the numbers, but probably I don't know. It's a few hundred years ago, no? Like I don't know, 1500s, even before, no? Um, Probably when, yeah, the discovery of America and so on, no? But what we can agree on is that people have been smoking tobacco for a lot of time. Um, so the question is that if people have been smoking tobacco for 300, 400 years, what are the chances that people stop smoking tobacco in the next 50 years? And obviously, I mean, we can agree that consumption of tobacco probably will decrease, but it's very hard that an habit that has been ingrained in our society and in all societies around the world for so long disappears very fast, no? And probably what will happen, consumption of tobacco will decrease, but some other forms of consumption of nicotine um, will increase, no? And we already seeing this with products like Zine and so on. But we can see that the market probably will not disappear overnight, and I doubt it will disappear in the next probably 50 years. Um, and let's repeat the exercise, no, for some other industries. So we could ask ourselves, for how long have people have been flying in planes commercially, no? So basically traveling for business or for pleasure in planes. And actually, I checked this one out for curiosity. And the first commercial flight was in 1914. No? So for more than 110 years, we've been flying in planes. And the question, no, it's the same. No, how likely is that we stop flying in the next 50 years? No. And this has a meaning. No, this has a meaning for the airlines businesses. Obviously, I'm not saying airlines are a good business because I don't think they are, for other reasons. But we could look at airports, for example, no? Like we could look at all the components of the industry and try to understand what type of, let's say, aspect of the industry is the more attractive from an investment perspective. But what I'm trying to get to is that probably people will not stop flying in the next 50 years, and probably this will increase, no? And then we can ask, we discussed technology stocks and software stocks in some other videos, and I also mentioned that this ratio doesn't work maybe so as good enough for them, but we could ask a similar question, no? Like, for how long have people have been using Instagram? And I don't know if you know, but Instagram was launched in 2010, so 15 years, which is quite a lot. And we can ask the same question as before, and it's how likely is that people will stop using Instagram in the next 50 years? And here you can see where I'm trying to get to, no? Like, I think it's quite likely that this happens because for two reasons: because it has not people have not been using it for that long. 15 years it's a lot, but it's compared to other stuff, it's not that long. And the technology industry overall, it's an industry with a very high rate of change, no? So people are now shifting to TikTok, and then in 5 years we'll have another thing that it's a new TikTok. And the way people interact with technology and social apps and so on, it's changing very fast. So even though it's a great business, I doubt that in 50 years people will be using Instagram. And maybe we'll be using another thing that it's also owned by Meta. And we should still be investing in Meta, no? But I think this is a common sense approach to think about business modes in the long term. And I think people will be, consuming tobacco and flying in planes for much longer, then people will be using Instagram. No? So Instagram will disappear probably much sooner than those two other industries. And that's it. Anyways, I'll finish the video with this, and I think the key point here is that we need to remember that before investing in a business, we first need to decide if it's the kind of business that we want to be in the long term, no? And that's before we even look at the valuation of the business. And this obviously has some caveats, because especially, if you look at very small cap companies, you could find huge mispricing situations where the valuation doesn't make sense at all, and it's so mispriced that it's actually worth it to take the risk. But this is very rarely happens, with mid-sized and mega cap stocks like Microsoft, Google, and all of these. So you will rarely find one of these companies mispriced based on the financial perspective. But I think what most people miss is the business part, no? Like, I think some of these companies that look rightly priced based on discounted cash flows are mispriced. And the ones, some will be mispriced because they will be overvalued, because we're assuming that this company will remain in business and with the returns of capital for a very long term, which it's not the case because it doesn't have a strong defensive mode. And some others probably will be undervalued, no? Because even though it seems like, based on the discounted cash flow, it seems correctly valued, the company has very strong defensive modes, and it will actually go higher than what the discounted cash flow tells you. Yeah, and I think that's it. Feel free to put any questions or suggestions or ideas in the comments. Hope this was useful, and have a nice day.